self-made strategy, Capital Dividend Account strategy for Canadian business owners. If you're a Canadian corporation shareholder and you're not leveraging your Capital Dividend Account, you are leaving tax-free money on the table. And I mean that literally, tax-free money that you are legally entitled to extract from your corporation and put directly into your personal pocket without paying a single dollar in personal income tax on it. Hi, my name is Rory McCaw. Welcome to Self-Made Strategy. I'm a serial entrepreneur. I built an IT services consulting company starting in 2001 and sold it for 8 figures in 2018. And one of the things that made that exit as financially successful as it was understanding the tax structures available to Canadian business owners that most people simply don't take advantage of because they don't know about them. This video is about one of those structures. It's called the Capital Dividend Account, or CDA, and it is one of the most powerful and underutilized tools available to Canadian private corporation shareholders. So let's get into it. What is the Capital Dividend Account? The Capital Dividend Account is a notional account, meaning it's a running balance tracked by your corporation, not a physical bank account that accumulates the non-taxable portion of capital gains realized inside your corporation. Here's how it works at a basic level. In Canada, when a corporation realizes a capital gain from selling stocks, ETFs, or real estate, only 50% of that gain is included in the corporation's taxable income. This inclusion amount has now changed on January 1st, 2026 to 66.6%. This now means that 66.6% of the capital gain is taxed and the other 33.4% is the non-taxable portion. And that non-taxable 33.4% gets added to your Capital Dividend Account balance. Now here's where it gets interesting. Once that balance exists in your CDA, you as the shareholder can elect to pay yourself a capital dividend, a dividend drawn from that CDA balance, and that dividend comes out to you personally, completely tax-free. No personal income tax, no dividend tax, nothing. I've used this strategy for years, and it has made a material difference in how efficiently I've been able to move wealth out of my corporation and into my personal hands. Example 1, selling appreciated ETFs. Let's walk through a concrete example. Say your corporation purchased $200,000 worth of broad market ETFs. Think TSX or S&P 500. Over a few years, those ETFs appreciate and you sell them for $300,000. You've realized a capital gain of $100,000. Under the new 66.6% inclusion rate, roughly 66 out of 600 is added to your corporation's taxable income. The remaining 33.4%, approximately $30,400, flows into your Capital Dividend Account. Now you can file a CDA election with CRA. It's called a T25-4, and pay yourself a capital dividend of $33,400. That $33,400 lands in your personal bank account, tax-free, no personal income tax, no dividend tax, nothing. If you had paid that same amount out as a regular salary, you'd be paying between 25% and 45% in personal tax. The Capital Dividend Account just saved you potentially $8,000 to $15,000 in personal tax on that single transaction. That is still a very real, material, legal tax saving, even under the higher inclusion rate. And it's money you're legally entitled to that most Canadian corporation shareholders are simply not capturing. Here's a second example. Say your corporation has been holding a concentrated stock position, like a bank or tech company. You bought it $50,000 and it's now worth $150,000. You decide to sell, you've got a $100,000 capital gain. Under the new rate, $66,600 goes into taxable income. The remaining $33,400 flows into your Capital Dividend Account. Now here's where it still gets interesting. If you've been accumulating CDA credits over multiple years across different assets, let's say your CDA balance has grown to $120,000 or $150,000, you now have the ability to pay out that entire balance as a tax-free capital dividend in a single election or multiple elections over time, depending on your cash flow needs. Yes, the non-taxable portion is smaller under the 66.6% rate than it was under the old 50% rate, but the fundamental principle hasn't changed. The CDA credit still exists and you can still extract it completely tax-free. The strategy is still very much worth executing. You just need to be even more intentional about when you trigger gains and make sure you're having that conversation with your accountant proactively rather than after the fact. A few things to keep in mind. First, the capital dividend account only applies to CCPCs. If you're operating through a public company or a non-CCPC structure, the rules are different. Second, the CDA election process has specific requirements. You typically need to file the T25-4 election on or before the date the dividend is paid. Getting this wrong can have serious consequences, so don't wing it. Third, the capital gains inclusion rate has been a moving target in recent Canadian federal budgets. If that rate changes again, the math shifts, but the fundamental principle of the CDA remains intact. The bottom line: if you are a shareholder of a Canadian private corporation and your corporation is investing in assets, you should be having a conversation with your accountant specifically about your CDA balance right now. Ask them, what is my current CDA balance, what transactions contributed to it, and how do I extract it? I will tell you from personal experience that the answers have put significant tax-free dollars in my pocket over the years. It's one of the strategies I wish I had understood and implemented earlier in my entrepreneurial career. Now, I want to be clear, this is not financial advice. I am not an accountant. I am not a tax professional. I'm an entrepreneur sharing a strategy that I have employed successfully for many years. Every situation is different. Please speak with your accountant before acting on anything in this video. They will confirm your specific balance. I hope this gave you a useful starting point and opened your eyes to a tool sitting in your corporate structure right now. If you found this valuable, hit the like button. It helps more business owners find this content, and hit subscribe. There's a lot more coming on tax structure, exit planning, and building an IT services business. My name is Rory McCaw. This is Self-Made Strategy. Good luck out there.